everybody. Welcome to Know Your Money. I'm Bronwyn Weiner.
And I'm Craig Finch, and we are from Growth Financial Planning. We hope you enjoy our podcast.
We have Marteen here today to talk about some topical taxes and laws around trusts. Marteen, do you want to introduce yourself and let us know what you found is topical?
Thank you, Bronwyn. Yes, I'm Marteen Michau. I'm founder and director of Fidelis Vox. It is a business of fiduciary specialists. The name Fidelis Vox means trusted voice. We specialize in all aspects of fiduciary matters, trusteeships, trust, setting up of trusts, often terminating of trusts, deceased estates, wills, and this is for assets locally and abroad, and also cross-border and local tax opinions and tax advice.
Welcome.
Yes,
thank you.
Thank you so much.
Yeah. So there are topics that are not concerning, that have been brought up lately, and you're going to discuss a few of those with us today.
Yes. One of the first is just some changes that came through in the last year in South Africa. The one is when capital gains tax legislation was introduced, it's always been the case that when you distribute capital gains or vest capital gains in a South African trust in a beneficiary who is a non-resident, and we often have that with South African parents have got children that went to work offshore, they've become non-resident for tax in South Africa. So now you give them a capital gain out of the SA trust. It's always been like that the gain is not taxed in their hands, but taxed in the hands of the trust. So the conduit principle in trust is really ignored in this instance. So what's happened last year is they've extended this to all taxable income in a trust, not just capital gains. So any taxable income that you vest or give to a beneficiary who is a non-resident for tax in South Africa will not be taxed in the hands of that beneficiary, but will be taxed in the SA trust. So what this has as a consequence is that you often have double taxation, because now it's taxed in South Africa in the SA trust and for capital,
at higher rates.
Capital gain at a high rate. And now the individual is most probably paying tax in the jurisdiction where they are tax resident.
So let's say London.
UK, US, Canada, Australia, New Zealand, or wherever they are, they may be taxed at quite punitive rates in their country of tax residency. But they cannot apply a double tax agreement that South Africa may have with that jurisdiction to this fact that there's double tax here, because we're dealing with two different taxpayers. It's not the same taxpayer paying twice. It's the individual paying in their country of residency and the SA trust paying in South Africa. Two different taxpayers can't apply the double tax agreement.
So could we put like a number on the example? Let's say it was R1 million and they would pay, what would they generally pay in the trust in terms of taxes?
Say the gain is R1 million. In the individual's hands, if it was a resident, you would have taken 40% of the gain taxed at that individual's marginal rate, where that brings them at what marginal rate bracket. In the trust, you take 80% of the gain, not 40. You take double the amount of the gain, taxed at 45%.
Sure.
Really?
So in this case, would you unwind that trust then, or try and unwind it?
No, you would not give capital gains to non-resident beneficiaries. You will, if you want to vest capital gains in individuals, give it to resident beneficiaries and not the non-residents. And now also all taxable income in a trust. So if you don't want to distribute it or vest it and you keep it in the trust, then it's taxed in the trust.
Mm-hmm. But I think maybe your question is, if all of the kids now don't live here anymore and they all live in these other places and no one's a resident in South Africa, would you unwind?
Then you're going to retain in the trust and assess, why did we set this trust up in the first instance? Is that still valid? Is that still applicable? Are some of these children going to come back, or some of the beneficiaries going to come back to South Africa at any stage? Are you just going to leave everything in the trust protected, not let it fall into anybody's estate, leave it there as a pot, investment pot, until that happens, or are you unwinding?
So, and would an endowment play a role here as well? So in other words, you could take whatever assets they've got, maybe send it offshore in an offshore endowment, and there could be continued across the border.
Okay, you just got to also keep in mind exchange control regulations.
Yeah.
In terms of exchange control regulations in South Africa, at the moment, South African trusts may not hold direct foreign assets. They will not be able to hold a foreign endowment. They can hold asset swaps, but not direct assets. So, but you will in this instance look at all the different
All the
solutions and
options,
scenarios to see what will be the best.
Okay.
Yeah. Something else that happened last year, I'll just explain the legislation first. If you distribute or vest a capital gain in a South African trust to another South African trust, so you often have that in a family where they've got more trusts. Say the father set up a trust, now the children have got married again, and each of their families have set up their own trusts as well. The father wants to fund those trusts and put something in there for them, wants to make a distribution from the SA trust, his SA, if I can call it his, it's not his trust, to their trusts. So, and say he uses, there's a big capital gain, he has sold investments or sold a property, wants to put that capital gain, distribute it or vest it in their trusts. Capital gain from one SA trust to another, even if in that second trust, the receiving trust, you take the gain down to the individuals in the same tax year, it's still caught and taxed in that second trust.
So it's still taxed the
At the high
80%
rate.
inclusion,
Correct.
45%.
Correct. So what happened last year, there was a court case, a Thistle case. What happened, the taxpayers, they did exactly that. They distributed the capital gain to another South African trust and they took it down to the individual beneficiaries. And they declared the capital gain in the individual's hands at 40% of the gain at their rates. And SARS came back and said, incorrect. It's actually taxed in the trust at the higher rates. You didn't pay it there. There's penalties and interest. And it was a huge tax bill.
Sure.
They went to court. It landed up in the Constitutional Court, actually.
Wow.
And they found in favor of SARS and said that the legislation is quite clear. It's caught in that second trust and it's taxed there.
And if one of those, so this one that's trying to make the second trust, if he was a beneficiary on the dad's trust,
As an individual.
And it went, the gain went to him from there, and then he took that.
That's fine. It would have been taxed in his hands.
And then when he gave it to the trust, would that have been a loan to the trust?
Yes.
So
Loan
that
or
way-
donation. Yes. So one's just got to be very careful and keep all of this in mind when you decide to distribute or vest in trusts or in non-resident beneficiaries.
Yes.
Yeah.
And Marteen, tell us about an SA trust and trying to get stuff into an offshore trust.
Okay, what we had to do in the past, which came with a lot of complexities, because a SA trust doesn't have a foreign investment allowance in terms of exchange control, it can't do that. So you used to have to take...
So just a foreign investment allowance, you allowed
Thank you.
Okay. So you're allowed R1 million, but up to 10 million rand, everybody is allowed to... but you've got to get a SARS clearance to take...
I remember this, yes.
Yes.
Yeah,
Yes,
you're allowed
I
a
do
million
remember this.
plus a 10
Yeah,
million.
I remember
10 million
this,
is
yeah.
on clearance. Yeah.
Yes.
So now you have to get it into the hands of the individual to get it out of the country with foreign investment allowance. So you typically make a distribution or loan from the SA trust to the individual. Individual takes it out foreign investment allowance and they invest in their own name offshore or put it into an offshore trust by way of a loan. These have all got tax consequences, especially the loan to the offshore trust. Transfer pricing rules become applicable. You've got to charge interest at arm's length and it's taxed in your hands in South Africa. So obviously, it's huge.
It's messy.
Now they are allowing application to SARS and the Reserve Bank to distribute directly from the SA trust to the offshore trust. Offshore trust got to be a beneficiary of the SA trust, so you miss all of this.
Do they have to be the sole beneficiary?
No,
Or, okay.
one of the beneficiaries.
And
Can
then,
be part of a class.
okay. And you're saying it's an application. So do you know what would make them deny it necessarily, or?
I've only seen the approved ones.
Okay.
So it's an application first to SARS and they want to see that it's a beneficiary. They want to know exactly what you're doing, what's going, and they only approve it for cash.
Okay.
And then it goes to the Reserve Bank also for approval.
And is that only up to the 10 or is there more?
Unlimited.
Okay.
Marteen, in your experience, how many trusts are valid? In other words, are the legal agreements in place? Do they have a bank account? Are they have audited results?
The compliance requirements have just gone through the roof lately since South Africa's been grey listed.
Okay.
and they're enforcing it. They're really enforcing it, but there are still a lot of trusts that's not compliant. That we see, we get them, they sit in front of us, and that's the first thing we look at because now there's massive fines, 10 million per trustee if you're not compliant. From a financial intelligence center point of view, from a money laundering point of view, the things that you have to do and have to have in place. So people have to get compliant and get compliant.
And you can help them with that?
Yes, we do. We do.
And I think that's what's so great about your services is you don't just write the document. You'll also explain all of these things that if this money comes in here, these are the tax consequences that will apply. If you take it this way, that's what can happen. And I just remember once at the Fundhouse conference, you spoke about what you do in the family meetings of how to kind of gauge if this is for you. I remember you said you sit around a campfire. Can you maybe just explain that a little bit just so
yes, that's
people
what
would
we
know?
call a family charter workshop with families. So what we do is we really unpack from the person who set up, say, the family business, where did they come from, what hardships did they go through, what did they have to endure and do to actually get this, create this wealth and get this up and running. Because the whole issue is succession to the wealth. When you pass the legacy or the wealth on to the next generations, that they don't squander it, that they understand. Because they didn't work for the money, they might just spend it. And the research that they've done is it used to be the third generation that spends it and squanders it, now it's the second. Sure. So it's become worse.
That's good, yeah.
So what they say is don't pass money on, pass a legacy on. Then the chances are better that it's protected and not squandered like that. So we have this whole workshop around how it came to be, how all this was created. That's a story we normally have like on a Friday evening around the campfire, because a fire is good for a story. And then the next day, the workshop where we get working papers dished out to everybody. And it's often we have 3 generations on the workshop, the grandparents, parents, and children, which is great. Because the ideas, you get the different types of ideas. And then you work through to set up this family charter for the family, but you work through family traditions, values, charitable giving, what they want to give to, what's the long-term objectives of the family, whether business or the wealth. And you unpack that and then put a family charter together on all of this. And what we do, we always include the investment advisors, we include the lawyers, family lawyer, accountants, whoever is involved with the family, that they understand this charter, because going forward, you want everything to be matched to it and fit with it, with the long-term objectives of the family.
And it's truly holistic planning, because to go to someone and get this and do your planner there, it just doesn't make sense. And I think it's beautiful. Thank you so much.
Pleasure.
Dean, thanks for your time today.
Pleasure.
Thanks.
Thank you for listening. If you have enjoyed this podcast, would like to subscribe, please visit our website, www.growthfp.co.za. The information we have provided in this podcast is our personal opinion. For more detailed information, please discuss your financial situation with a financial planner.